a less bullish type of look, but not a bearish one, I would say.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. I am joined this time around by Joe Camp of Comstock Investments, and we are going to take a look at Wednesday's trade at midweek here in the ag commodity markets. Joe, this week is kind of throwing people curves all the time. Wednesday, it was a big down day led by the soybeans on the grain sector. What happened there?
Roller coaster has been the word used in several conversations as we talk with growers and look at ways to hedge, ways to protect, ways to take advantage of what can still be some bullishness out there as well. So all different directions. The pressure on the soy complex that you ask about, I think for me, started with the South American influence turning relatively more negative, or at least less bullish. What had been somewhat supportive were these conversations about the early harvest delay in Brazil, soybeans coming out, but particularly in Mato Grosso, well behind almost half of last year's pace to start. What we were more focused on this morning, though, were these new estimates, projections for the rest of the month ahead, February being a record month for Brazilian soybean exports. And how do you have record exports if your harvest is starting slow? Well, Mato Grosso, the center west area, so key and will be still important for these implications on safrinha corn, by the way, if they are going to push back the planting window beyond what is most ideal. That's something we'll talk about again. But elsewhere throughout Brazil, not as much of a delay, and so still beans to fill the trade pipeline. And exports are coming out of South America, not only from Brazil, but also word that China has been booking soy and soy products in particular. We know about Argentina being projected as the top meal exporter here this season, even with a lower crop. That leaned on the competitiveness, or at least the outlook for soybeans out of the U.S. And then add on to that these better conditions that have been reported out of Argentina, some rainfall. So even with a lower crop expected this season due to drought, it's maybe not as bad as it could have been feared just a couple of weeks ago with these latest showers. And then the final thing, I think we have to look at the energy market and the sell-off for crude oil and the products, and that pinching what could be margin outlooks for the processing sector. So all around, mostly negative for the soy complex, and that we could tell was something that drug on the corn and beans to a lesser extent.
Well, we do seem to have demand still continuing from Mexico on the corn, don't we?
Yeah, we do. And in fact, we saw a new flash sale for the new crop, for the next crop. And to have that country, the top buyer of U.S. corn here for the last several years, sustaining that interest, even amidst all of the tariff uncertainty, it's a positive sign. And we know that was the case earlier this week with the strength coming off of the back of these reports that tariffs had been delayed with Mexico and Canada for at least a month. And that continues to support then this record demand flow from Mexico on U.S. corn. Now, they're coming off of several years of a severe drought. They absolutely need the corn. And it was maybe not as much of a surprise either to suggest that Mexico would retaliate. They would talk strongly against U.S. tariffs being implemented, but they wouldn't be expected to go straight for banning U.S. corn exports or canceling previous purchases all the same. So that we had that sort of relief following the initial knee-jerk step out of the market type worry is not overly surprising here.
You know, on the daily corn chart, it seems like we're just kind of hovering close to overbought status for almost a month and a half now.
Well, one thing I wanted to point out was this, concept of bearish divergence, and that was actually something that made the move yesterday look suspect. Now, the strength, relatively speaking, at the close, that these back months, July and beyond, were higher, that the May recovered to unchanged, that it's holding support above that critical $5 mark. Those are all positives. But yesterday, what was looking a little bit concerning was the fact that we were up towards last week's highs, recent highs for the move, and having price strength over the two sessions to start the week without the same follow through on the momentum studies, just your basic indicators like relative strength or the moving average convergence divergence, the MACD, that they weren't trending higher in a convincing way along with price is what we can think would possibly open that so-called bearish divergence here. And in fact, that's, I think, something we seized on or saw the speculators seize on early in today's trade, that potential waning of momentum, at least for now. Same could be said for soybeans, where yesterday you had a poke to a new high, but mostly a still lower trending set of momentum studies. So something to watch out for. It's actually something we could bring up was the case for hogs today on the rally as well. Why we won't be necessarily surprised if we could see that market lose strength before it matches this recent high as well.
Get to that one in just a second. I did want to touch on the wheat. Wheat just kind of lives in the shadows. It's been in the depths for so long that all the focus seems to be on moves in corn and soybeans. But the wheat, even though it was down today across the board, it's just kind of slowly grinding higher, and it's not really getting much attention, is it?
Yeah, that's right. And it's sort of that in-between time of the year, of course, for our season, the winter crop dormant. So it is a market that is sleeping, if you will. Now, it's very much sensitive to the ongoings abroad, particularly with the Russian market, for one. There's been some movement on back and forth on whether or not we could see some move towards an end of the war in Ukraine, and would that open up in an even bigger way grain flows from that region. At the same time, Russia coming off of a smaller crop, expected to have diminished exportable surpluses, yet we keep saying that, and they keep pumping out big volumes with some rebound for price to help take the pressure off of the U.S. market, but not an overly convincing turnaround just yet. So we're continuing to see that market really lead the way. Lately, it's been mostly higher, but not outstandingly so. The one thing I'd say, if we reel it into this U.S. market, it could be the opposite of what we've observed with that waning momentum on the corn and soybeans. We did not have that being the case where yesterday the relative strength or the moving averages were still short-term moving higher along with price. And so that can be a bullish sign, and one that if we pair with higher volumes like we observed here recently and still steady or climbing open interest, that could suggest that the funds are not only covering shorts but turning a bit more bullish than they had been. We know that those speculators are already net long the corn and soybeans, and so they're potentially in the process of flipping direction on the wheat. That's a better sign than what we've seen lately, and it does account for why the wheat futures are now at, say, 3-month high.
Kansas City wheat, that would be the hard red wheat. It hasn't been above the 200-day moving average since June last year. And Chicago wheat is basically the same way. Had a couple trading days in there where it kind of peeked its head above it just momentarily. But by and large, I mean, we've been way below the 200-day moving average for a long time. Now, it's getting a little bit closer, but do you think it has to clear that before it can finally get some buying?
I would say the first thing it has to clear is $6, and we did have the new crop July contract, and that's in the Chicago market. I was just referencing. The May Kansas City did settle over $6. For the March Kansas City, it needs to be over $6 before it can test that 200-day moving average that you mentioned at around 608. Coincidentally, if you will, the last time we had clearly tested that 200-day mark, we'd failed, but we had tested it back at the last interim high at around 636. And so those are the next targets. You got to get past the psychologically important $6 mark in the nearby contract. Again, that May and beyond or above $6 is important, but not as technically influential, given that the nearby March is still the most active, the highest open interest, and where the speculators, by and large, are going to be remained positioned. So number one is $6. Number two is the 200-day moving average, which is just ahead of that. And then that last attempt at the 200-day, the last seasonal high at around 636.
Well, we had a big bounce in the livestock trade today, cattle and hogs. Of course, this is after we had the big down day here recently. Um, what do you think that means? I mean, are we seeing a resurgence of strength? Is this just a temporary bounce in a bigger correction? How do you look at it?
I think it's a stabilization of a market that has undergone a correction that could be both hogs and cattle, where we had not just last week, new record long announced in the live cattle futures. We were coming off of a couple of weeks in a row of fresh record net longs in feeders. We're now a couple months removed, but not very far from record net longs in the hogs. And so we have undergone this process of a correction, of settling the technicals. And then we see, okay, are those speculators prepared to flip direction and turn bearish? And the answer has so far been no. They're actually looking at this break as an opportunity to reload from the long side, to defend their positions and resume the buying. And not only this move lower, was it something that settled the technicals, but it was also something that restored these big discounts. Now we have to talk about the cattle in particular on this, these discounts for the board under the cash market. So you look at a February live cattle at around 203 and a half, still talking about cash trade out there at 208 to 210, wondering how that'll develop a little bit more fully maybe this afternoon or certainly into the rest of the week. But as you had that 4 out of 5 day sell-off for cattle futures, that was something that all of a sudden said, okay, we've gone far enough, at least relative to the cash. Now, will those packers, they're certainly going to attempt to slow things down, to move back on purchases, but they're up against now much colder weather, and that limiting maybe offerable supplies out there, and trying to fight against as well the big drop that we're seeing in cutout values, at least as this morning's report stood, down $4 more than for choice and a couple dollars lower for select.
You know, I like to watch chart patterns, and it worries me some, Joe, that if you look at live cattle and feeder cattle, boy, I tell you what, even if we would rally a couple more days now, but then fail, wouldn't that set up a head and shoulders on the chart?
Yeah, that's something we'll look at here relative to the recent interim high that was right around 200. So it coincides with a very important even money mark like that. Then you had the quick spike, but then so far the loss of that momentum, the correction lower. And it's very similar actually to the hogs. I was going to bring up hogs as having what could clearly be a developing head and shoulders pattern I mentioned. And it's more clear in the hogs, I would say, for now than the cattle, this so-called bearish divergence, where we are marching back towards those new highs on price, but not catching up or keeping pace on the momentum. And so if you fall short of now last week's contract highs for the summer hogs, that is a much clearer head and shoulders pattern prediction that we would see possibly develop here. And for the cattle, yeah, similar look, a much sharper head on that than we could see borne out in the hogs. But a really interesting pattern where not all is lost yet either, because of today's recovery. You put it right back above the middle of the range, that 20-day moving average, which is still for now trending higher. And you have to chalk up then this latest, again, 4 out of 5 days down from a new all-time high, mind you, as well, as just a technical correction. And I've said that, in our conversations to producers, when we look at how do we be defensive, how do we be flexible, how do we take advantage of the recent rally without trying to be too bearish. And the idea is that we could have these types of corrections, that you could still break this market another, in my mind, $6, $7, $8 down on both live cattle and feeder cattle before you'd even be testing the bottom of the uptrending channel. And so if you're talking about feeders, down 20 some dollars from their highs and still keeping the long-term uptrend that we've been in now, for the last 5 months. So a more, bearish, or not, a less bullish type of look, but not a bearish one, I would say.
When you were talking about the lean hogs, which month were you focusing on?
Yeah, right now I'm looking at the June hogs for that technical head and shoulders pattern that we brought up. You could have a similar look at the nearby contracts, but right now they're maybe anchored more to what we're seeing trade out there in the cash. I chalk that up as important that the February at 86.65 settlement today is going to be right at where most of the direct business is being recorded. So it's kind of stuck there potentially while we see more up and down in these summer contracts where you'd have the technical weakness offset against possibly some fundamental bullishness, the support for the fact that we should see pork output decline into at least the second quarter of this calendar year.
Any thoughts on the outside markets, like the equities that have been at times taking a beating? Let's see, what did they do here today? Well, today they're up again. So very choppy action there. The crude oil market was down, like you mentioned, and the precious metals are all over the place too. What do you think?
Yeah, I'd have to call the outside financial markets relatively resilient here, and it's something that can allow that correction type of action for the cattle not potentially turn into anything deeper or more bearish because of the way the stock market's holding up and signaling relative strength for consumer sentiment for all that we have in terms of worry about the economy and about finances and inflation continuing to be persistent. Maybe that's more of the attention being paid, that we still have rising prices in most places. The speculators know that as long as they're as aggressively bullish as they are, they've got support from index funds that have big money parked into the commodity space as a whole. But we do have to watch that really important leader, as you mentioned, the crude oil being down like it is. I think the general idea is that we're now testing support at the bottom end of the most recent range that bottoms towards $70, and that with all that can pop up in the Middle East or with Russia, Canada, etc., that we could have upside from here. But that was definitely part of the lower trade today, that you had the bean oil retreating back lower when crude oil and the products were down, and that you also had a negative crude oil inventory update that relatedly involved some more negative ideas about ethanol because of ethanol stocks now building to record levels. It's not a bad thing that you have record ethanol production. We're using a lot of corn, and that could actually be a point of bullish revision for the crop report next week. We'll foreshadow. But at the same time, these record stocks of ethanol make us a little bit concerned, and that was expressed in the down move with energy and the grains today.
Interesting stuff. All right. Well, thanks for explaining everything. Always good to talk with you, Joe, and look forward to seeing you also at the Family Farm Masterclass coming up later in February. That'll be on the 21st and 22nd of February. I encourage everybody to check it out. Just go to comstock.com and then click on that masterclass, the link in the upper right-hand corner, and you can learn all the details and even register for the event. Well, thanks again, Joe. We'll talk to you next week. Joe Camp of Comstock Investments. That'll do it for this episode. Thanks for joining us. For producer Breanne Jenkins, I'm Marlin Bohling. We'll catch you next time right here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.